Ladies and gentlemen, welcome to the mini course on demand rejections, right? So over at the High Performance Trader, I look for every single day opportunities to get in and out of the market successfully, right? And one of those ways, right, one of those strategies that I use is called the demand rejection, right? So we are a group of traders over here that capitalize on price and volume analysis, supply and demand zones, right? And what I like to call areas of value. One of those areas that we're going to be talking about today is demand, right? So in this lesson, we're going to be breaking down tons of valuable content, right? So the lesson goals is how to identify market conditions, right? How to identify buying opportunities, right? And in this case, it's going to be demand rejections, right? I'm going to be breaking down how I identify where I'm going to be getting in a trade, right? My entry, my target, and my stop loss, right? Because I cannot and will not get into a trade without these three areas already predefined, right? Very important. So we're going to be breaking down why that's important and how we do it. And also I'm going to be breaking down how to capture the market imbalance, right? Because anybody can get in a trade, but unless you can identify where she is headed, you are going to constantly run into walls and fail as a trader, right? So let's break right into it. So what is a demand rejection, right? So a demand rejection is an area where buyers previously stepped up to defend price, causing price to reverse, right? A demand zone. So in this scenario, we have demand over here at 406, right? So previously, buyers has defended these areas, right? And that is an indication, right, that is an area of value where buyers like to step up, right? So these are areas where there is a larger number of buyers versus sellers, right? These are areas where there are more shares of demand, right? Demand of shares is greater than the supply of shares, right? And this is what causes the market imbalance. This is what causes price action to move, right? Usually pretty violently, right? These are areas where we look for opportunities to take the market long, right? So demand, every time I say demand, I want you guys to think of long opportunities, right? These are areas where we're looking for buyers to defend with strength, right? So first thing I do, right, before any trade is identify the market conditions. It's very important, right? So what you want to do while identifying conditions is understanding what sort of trend you are in. Are you in a downward trend? Are you in an upward trend? Are you trending sideways, right? So identifying market conditions, right? You're going to identify areas of value on larger time frames, right? Supply and demand zones, pre-market highs, pre-market lows. You're going to identify a bullish or bearish trend, right? You're going to run through the fundamentals, right? Which is news. Is there any CPI news coming out? Is there anything that is going to cause extra volatility in the market today, right? And you're also going to look for chart patterns, right? This helps you identify, hey, there is a large double bottom over here at 406. We are in an uptrending market, right? We are making higher highs and higher lows. I would rather trade with trend, right? So what that means is since we are in an uptrend, I would rather wait for price to retrace to a demand zone, right? And take the market long, right? Trading with trend. Trend is your friend. I'm sure you heard it before. That is how you trade with market conditions, right? Very important. So before you make any moves on the market, it is very important to develop a trade plan, right? So this is a plan that you are going to stick to. This is a plan that you are going to identify and predefine before you enter a trade, right? So our trade plan for the day on this day, right, is in the event price comes down to 406 demand, right? We are looking for buyers to show up. We are going to do this by identifying a chart pattern, right? Or with buying pressure, right? And this is going to give us our signal for buying opportunity. So let me just break down how I got that. So going back a slide, you could see we've identified we are in an uptrend. We are making higher highs. We are making higher lows. Our trend is our friend. Our uptrend is going to help us identify buyers, right? Because to be in an uptrend, that means buyers are currently stronger than sellers, right? So then when we break down on a shorter time frame, you can kind of see where the last time buyers showed up violently, right? So where we see that is over here at 406, right? I got it circled. So every time price came down into 406, we got buyers, right? So sellers pushed down, buyers pushed up, right? And then we get this, what is this? $1.15 move out of demand, right? This was April 8th. And then on April 9th, Price came back down to demand, back down to 406, and then we got this $3 move, right? Indicating buyers are getting stronger out of this area of value, right? So in the event price comes down to 406 demand, we are going to be looking for buyers to show up, identifying a chart pattern with buying pressure, volume, signaling buying opportunity, right? So it's very important to understand. You need to identify your areas of value. 406 demand is our area of value, and we also have 409.50, which is our supply zone, right? We've identified this because last time price was at this level, we sold off, right? Our stop loss is going to be below prior day's lows, which is 405.70, right down in this area. Because if price comes down to 405.70, that is invalidating our trade plan. That's invalidating our triple bottom that we're going for here, right? So we got once, twice, a third time is going to come into 406, and use price action to tell you what's happening, right? You need to be able to adapt to what price action is telling you. If price breaks below our 406 demand, right, or breaks below 405.70, that is telling us, right, that sellers are stronger than buyers. Buyers cannot control the market. So that will then trigger our stop loss, right? That will then tell us this is not working. We're getting out of the trade immediately and reassessing the situation, right? So the next slide I pulled directly from the Discord on 410. I put these every single day in the Discord, right, where I break down a bullish and bearish scenario, right? So you could see here, this is what I wrote for SPY, bullish scenario, 4/10/2023, 8:32 a.m. If price comes back down to 406 demand, looking for buyers to show back up with volume and chart pattern targeting end of day, which was 409.20, our supply zone, and then potentially 412.50, which is the next opposing area of value. Could expect some choppiness due to CPI on Wednesday, which was the following day. So I wouldn't blame you for taking profits quickly, focusing on scalps today. So this was the trade plan. This is what we were looking for, right? You can see I put a graphical presentation of what exactly it is I'm looking to do if price comes down to my area of value. Now remember, we do not predict the market. This is not predicting. This is developing a trade plan for what I'm going to do if and when price comes down to my specific area of value, right? It's very important for you to think like this, right? Once you start trying to predict the market, you are going to lose, right? You're going to fail. You're going to continuously try to be right. You're going to revenge trade, right? All these trading areas. So it's very important to remember all we are doing is identifying areas of value or areas of interest where we're looking for price to make a specific move based on buyers and sellers, validating our trade plan, right? Targeting the opposing area of value, right? So identifying the buying opportunity. So now that price has come down to 406, right? We can't just go long, right? Because remember, we need to identify the buyers stepping back into the equation, right? We use the candlesticks to tell us, right? This is the market's language. So we're going to use the candlesticks to go, hey, buyers are stronger than sellers right now. Go long. Now, how do we identify that? So we patiently wait for price to enter and start to reject the demand zone, right? Demand rejection. And this is at 406. So we recognize who is in control of the market auction through chart patterns and through volume. Now, I break this down in my online course, right? But chart patterns are nothing but selective human behavior. Now, what does that mean? Right, so every time you identify a double bottom, I don't care what time frame it is a graphical way of identifying buyer's strength. A double bottom means price came down to 406, right? Sellers just sold off heavy, and then there were so many buy orders, or limit orders, or market orders, where buyers stepped up at 406. So there was somebody, right? You could look at it like a bank, institution, market influencer. It could be Warren Buffett for all we know, that wants 1 billion shares at 406, right? So we look at this and we identify this through chart patterns and through volume, right? So we identify chart pattern within your area of value, right? So double bottom in demand, right? We have our stop loss in place, right? Below 406. I think we said 405.70. Right? And then this is where we go long, targeting the opposing area of value, which is supply at 409.50. Right? So now this is when we have entered the trade, right? We have our stop loss in place. Right? Now this is where most traders struggle, because you can learn how to identify entries, you can learn how to identify exits. But if you cannot control your emotions, it's going to be very hard to stay in this trade, right? And let me explain why. So say you enter over here at 406 and you take the market up to 407.50, right? As an options trader, say you went with in the money call option 0 day, you would be up around 100% on this move, right? So if you invested $1,000, you're up 1,000, right? So your $1,000 position is now worth 2,000. So when price starts to sell off all the way back to your entry, you're thinking you just gave $1,000 back to the market. In reality, your stop loss was never triggered, which means your trade plan is still valid, right? So the market's not just going to immediately rip to your target. That's not how it works. And the market will tend to move in all these crazy directions to weed out all the, what do we call them, scared traders, right? Who don't want to give that money back, right? But in the event that you sell here for, let's just say 750, you're leaving about 2 to 3 grand on the table by not sticking to your trade plan, right? So this confidence to stay in your trade plan, it comes through what I like to call conviction, right? And how you build conviction is by trading through for a long time, by sticking to your process, right? And most importantly, by logging your trades, right? And we're going to get to that in the next slide, but real quick, just look at how the market imbalance played out perfectly. You have your entry over here at 406. You have your pre-market high or your supply zone at 409.50. This, the S&P 500 literally closed at 409.80 this day, right? Completely capturing all that liquidity in between the market imbalance, right? So I want you guys to look at it like this. There's buyers here, there's sellers here, and everything in between is pretty much retail, right? So in reality, you have a buyer here that wants to buy billions of shares, and he can't just buy them all at once. That's what increases the demand for shares. Now, when the demand for shares increases, the price increases. That is what we are trying to capture. We're trying to capture a price going up in this scenario. So how it works is as this large buyer is buying shares and the demand for the shares are increasing because he's hitting the 1,000 lot, right? He's buying them by the 1,000. He's buying them, and all his friends are buying them, right? They're all working as a team, right? So when this is happening, you get this crazy price movements up and down, right? Like I said, nothing just goes up, nothing just goes down, right? So you need to develop the confidence, the discipline, the control, the conviction to be able to let your trade plan play out, right? It takes a lot of time to learn. So don't beat yourself up in the beginning. You're taking profits a little early. That is fine. There's nothing wrong with taking 30 to 50% off the top, leaving some runners, right? We break down tons of ways to do this in the Discord and in the online course. Check it out, right? So that confidence, that control, that conviction I was just talking to you about, how do you build that? Right? Well, you build that through logging your trades, right? So everyone on the Discord, right? Everybody a part of my team, everybody that knows, that follows me knows how strong and how I feel about logging your trades, right? So it is extremely important, right? And the way I do this, right? And let me just break down what I wrote. So the way I do this is I will copy paste my trade every single day into Microsoft OneNote. Right? And when I do that, I put the date up top, I put how much money I made, right? On this trade is $1,844. And then the percent, the return on investment, right? The ROI, which in this case is 122%. And then I write down kind of what went through my mind and how the day played out. So I put, after identifying demand at 406 from April 8th to April 9th, in the event buyers show up today via chart pattern and strength, I will be targeting pre-market high supply at 409.5. I recognize a double bottom at 406. Price cannot make a lower low, indicating buyers were stronger than sellers. This is when we went long, stop loss below prior day's lows at 405.5, targeting 409. Slam dunk trade today, stuck to my plan, and traded with supreme discipline. Right? So that's literally all it is. It takes about 5 minutes. Now, the longer you log your trades, right? Like the more time, the longer the time frame, right? The more successful, the more confidence, the more control, the more conviction that you are going to have as a trader to be able to identify these demand rejections, right? To be able to identify your trade plan, develop your trade plan, stick to your trade plan, right? I want you guys to think of your brain as a muscle. It literally is. It's the strongest muscle in your body. Now, the more you use it, the more you flex it, the more you work it out, the smarter it's going to become, right? The easier it's going to be to identify these opportunities, right? I'm sure a lot of you guys have seen traders, right? You can't believe how effortlessly they make it look. It kind of becomes second nature, right? Because your subconscious grows. Now, you are not going to build that muscle unless you log your material. Right? It's extremely important. It is what hands down changed my life as a trader, right? Until I started logging my trades, I had no confidence. I had no control. I didn't know where my strengths were. I didn't know where my weaknesses were, right? In the Discord, we log every single trade we take, and then we calculate the probabilities for success. And then we use that, right, as an indicator on how to identify market conditions. We use that as examples of trades we're trying to recreate, right? We call it log and recreate. It's super powerful stuff, right? It's very important to be a part of a team or even yourself into practice this, right? Because if you do not log your material, you are just basically a basketball player who doesn't practice, right? So log it right in your Microsoft OneNote. Right? This builds confidence, this builds control, this builds conviction, right? So guys, basically in a nutshell, this is how you identify demand rejections. I hope you enjoyed this lesson, and I will see you in the next one.